Good morning, everybody. I'm Jonathan White, the Chapters Accountant. As a firm of accountants, we have a massive toolbox of ways in which we can help deliver what we think you need as a taxpayer. And this normally, although not always, assumes that you're looking to minimise your tax liability and maximise your personal wealth. And you guys out there often see that we have a lot of tricks or tax loopholes which help us to achieve this. Now, these are merely rules which are often badly written by the government. And my skill set is not any magic, really. It's just that we've taken the time to understand all these rules, and we're very, very successful at identifying all the circumstances which might prevail, which we can use these to your advantage. One specific area of this, of our toolbox, is self-investing personal pension schemes, or SIPPS. Now, I've got to be quite careful at this point because I am not regulated to give financial advice, and pension planning clearly is financial advice. But of course, this week's presentation, I'm joined by with Rob, who is actually regulated to do this. So this presents a unique opportunity once in every 57 years, I guess, for us to work with Rob, as we've done in many instances before, and no doubt we will do it in the future. Rob can set out what a SIPP is, how it works, and I can actually expand on all the wonderful things that you can do to save tax. So I'm going to pass over to you, Rob.
Good morning, I'm Robert. I'm the Group's Independent Financial Advisor. Now, I am regulated by the Financial Conduct Authority and specialise in pension and investment work. Started young for the financial services industry, so I'm now my 34th year. And thankfully, the government keeps on changing the rules. So my landscape changes pretty much every year, keeps me always evolving for my advice for clients. Now, the rules that I have to advise on, they're similar to what Jonathan does, but different enough that I don't do what he does, he doesn't do what I do. So the advice we give each of our clients complements one another. Rather than it being two lots of the same, it's two times we're powerful together. So today we're focusing on that area of self-invested personal pensions. Pensions are necessary because you can't help but notice the government's short of cash. It cannot afford to keep us all in our retirement. And so we've got to make our own means, otherwise we're living on bits on toast. And as a species, we're living longer. But in that old age, we're doing more. So again, you need more to enjoy. Having a pension is important. Having the right pension is more important. And that gives you a really good retirement. And today we're going to show you how to capture more value by using a SIPP so that you can enjoy more in later life. So I'm going to look at the why you'd want to do this from the personal financial planning point of view. And Jonathan will then go in to explain the tax benefits for the business. SIPP. SIPP stands for Self-Invested Personal Pension. It belongs to an individual, and the government wants us to have it. So it's going to give you tax relief. It's going to make it really tax efficient. When you pay into a pension, you gain tax relief on what you pay into. And again, Jonathan's going to cover that in a nice worked example. What's inside the pension grows tax-free. That's what makes it so good. No, the government's not going to take it away from you. So no tax on gains, no tax on rental income. And that's why commercial property works really nicely. So the value of your pension sits outside your estate inheritance tax, so you're not then paying more to the government. That can save thousands of pounds to families. When you reach retirement age, which is my magic number, 55, you can access up to a quarter, 25% of your pension tax-free. If you die before 75, it goes to your family tax-free. So naturally, something this good comes with some compromises. And the government limit what you can pay into it. So maximum this year, 60 grand. So it's a decent amount. It makes a lot of sense to build up your pension. Jonathan, over to you to explain the tax benefits to a business.
Right. Okay. Thank you for that, Rob. So personal pension contributions and tax relief. This really specifically helps the higher rate taxpayer, but ever increasingly more and more of us are falling into that band because the higher rate tax now kicks off at £50,000, and most of us in this room should be earning that sort of money. The contribution level for self-employed or individuals is based on their net relevant earnings, which is, of course, their income, excluding rental income. So you don't count rental income or bank interest for pensionable income, but all other income counts. But if you're a limited company, and many of our clients are, you can actually max out your contributions based on the fact that you're a director of the company. So, as Rob mentioned earlier, you are allowed to pay in this particular tax year £60,000. But you can also use up carry forward tax release from last year. It was 40,000 last year, 40,000 the year before, and back to 2020-21, again 40,000. So when you add all these together, theoretically you could pay £180,000 this year into a pension scheme. And of course, if you're married or you have a wife or a husband as a partner or director in the business, this can be doubled. But looking at the basic rate of corporate tax, it's 25% now. Boo hiss. Thank you, Rishi and team. And as a consequence, on this £180,000 that you can put in, you could theoretically save £45,000 in corporate tax just by making a pension contribution. Otherwise, you pay the tax. So back to you, Rob.
So I'm going to talk through a worked example, and Jonathan's going to help us along with the tax on it, so you can actually see the benefit. So a worked example, I'm going to set the scene for you and look at choices. A real life referral. This is coming to me from Sophie. I've had an initial conversation with this guy, and so these are a real person. This is a limited company. He imports tyres for trucks and big vehicles. He's doing very well, 1.5 million turnover, and in making nice profits from that. He doesn't have obscure political views, so he went to Coutts Bank and got himself a nice loan for 80 grand, added that some cash in the company and bought a storage yard for 100 grand. The reason why, he can now import containers of tyres and therefore up his turnover, up his profit. So he's got 200 grand of profit in the bank already. So Jonathan, what's his tax position on 200 grand profits?
Well, unless he does something about it, his tax liability at the current rate of 25% is, of course, £50,000 on the 200,000, unless, of course, he goes off and finds somebody that helps him to do a SIPP.
I think I had a conversation with this guy about SIPPS. So I mentioned that the restrictions earlier, and Jonathan's covered that. So this client can pay a maximum this tax year, 60 grand into his pension, but he can go back because he hasn't done any pension planning. He imports tyres. That's what he knows. That's what he does. He's making a lot of profit at. So we had a chat, and he could use £180,000 of his 200,000 to pay into a pension. Jonathan.
So now he's still got a £200,000 profit, but he's paid £180,000 into his pension scheme. That's obviously reduced his profit. Now it's down at £20,000. So 25% of £20,000 is clearly a lot less than 25% of 200,000. His tax bill's fallen now to £5,000. So that's currently a £45,000 saving on the original tax bill. But we don't want to stop there. We're back over to you.
So he likes us. We've just saved him £45,000. That's a big saving. But savings are great. But if you lose control of the money, that's not so exciting. He hasn't lost control. He's just changed pockets out of his company bank account into his pension bank account. This sits in cash inside his SIPP. And because it's a SIPP, self-invested, the clue's in the name, he can choose what it buys. So guess what it buys? It buys the yard off his company. So if you assume it pays 100 grand for the yard, any tax on that, Jonathan?
No, not really, because he bought the yard for £100,000 and he's bought it back from the yard, from the company at no profit, no loss. So there's absolutely no tax. But what he can do, of course, is he can take that cash and clear the bank borrowing, saving paying interest to the outrageously expensive banks, the fat cat bankers. But the company does now have a liability, a responsibility to pay rent. So he's now going to pay, in this circumstance, £10,000 per year in rent to the pension company that now owns the property that he occupies. Of course, this is fantastic because this now gives us a £10,000 cost in the company, which of course reduces his profit by another £10,000. If you remember, corporation tax being at 25%, this saves a further £2,500 in tax. This means that his £5,000 bill that we didn't want to pay that, did we? Is now down at £2,500 from the original £50,000. He's actually saved 95% of his corporate tax bill from 50 grand down to 2.5.
So do you think this client's happy with us too? Yes, he is. But let's look long term. This is just this year. So long term. What's my magic number? Now he's 40 now, so he's got 15 years ahead. So he's just going to roll forward 15 years. Remember, we put 180 grand into his pension. He spent 100 of it. So we've got about 80,000. Yes, there's some costs and fees and charges, but bear with us. Simple maths. 80 grand in his pension. The yard's value's gone up £300,000, let's say. 15 years of rent at 10 grand each. Simple maths, 150 grand. And he's had spectacular investment growth. It's friendly financial advisor. So he's added another £120,000, gives a lovely round number, £700,000 in his pension. Inheritance tax free. and he gets 25% of that tax free. So what do you think his tax liability might be in retirement, Jonathan?
This is really good because initially on retirement, he can draw down 25% of the fund, as Rob said. That's £175,000 in his current account this afternoon. So if he used some of the balance, the 75% that's left in the fund, he could go into what they call drawdown, and he could pull money out of that every year. And he wouldn't need a lot, would he, if he's got £175,000 today to kick off? Let's say that he drew maybe £25,000 per year. Now, to be fair, I think that our personal allowances, which are now 12,570, will grow over the years, and hopefully in 15 years we should be able to earn maybe 20 or 25,000 pounds. And if that's the case, then he would have no personal tax on his pension drawdown because he's been using personal allowances. So all of a sudden he's got all this money absolutely tax free, and this would probably last him somewhere between 20 and 30 years. So if he's 55, he's going to be going 85, and he's probably not going to need a lot more money after 85. The nursing home fees can probably spend it.
He's loving it. But don't just take our word for it. But Jonathan and I, our officers are owned by our pension. But today in the room, Dave Clark is a very happy chap. He owns his officers through his pension. Bill and Trish is here supporting us. Trish does all the legal work in the pension. She wraps up and takes care of all the complicated big words. But their officers are in the pension. Nigel Rodley is here, and his owns it with his son, and we're doing some clever multi-generational planning. So his son's going to inherit it very tax efficiently. And Sophie, the mortgage home, her dad owns the property, and they do very well in that respect.
Yeah, so when you get businesses who are obviously paying a lot of tax and are moaning about paying a lot of tax, this is a clear door opener to say, well, there is something that can be done. Also, businesses that occupy premises that are renting and then moaning about the landlords. The landlord won't fix the things. They won't sort the driveway out. They won't sort the car park out. They're constantly just wanting to put the rent up on the business. That's outrageous as well. There are a lot of people talking about SIPPS. A lot of people understand very basic information about SIPPS. There's a lot of knowledge there. But really, to make it happen, you've got to do a lot of joined up writing to make it happen. And a lot of things have got to come together at the same time. And this is what we're particularly good at, because Rob and I and Trish in particular work very well together as a team, and we can provide the full solution to the full Monty to make the job happen. So really, I do need you to remember our strapline, which of course, conjoined this week is, it's not how much you earn that matters, it's how much you keep.